Well, good morning, everyone. Welcome to our Thursday morning trading room. I was going to do a little bit something different this morning. We'll look at the markets in a moment, but I thought what we would do is I got this question the other day from Todd, one of our DTS owners. And Todd has a question that I know is plaguing a lot of you. Namely, what do you do when the market moves against you? So Todd wrote me, he says, I'm trading the YM and I tend to find that my stop is around 18 to 22 ticks because this is where I find that I'm a few ticks behind the pivot that I used to enter. Okay, very good. I seem to see you using a larger stop when you're trading the NASDAQ. I really try to give my trade room to play out, and I know it's not a loss until you stop out. I also know that at some point, if your stop is too big, say 45 ticks, at some point it's getting to it, then we are heading for a change in market direction. I also know that if you stop out a very large stop, say 40 to 50 ticks, that it will really make it hard to trade out of that just to be even. It's a trading dilemma that I really struggle at dilemma that I really at times struggle with. I guess it's a matter of doing a few really good trade entries that really jump out at you, scream at you to trade. By taking these A trades, I guess it will enable you to use a smaller stop, say a little behind the pivot. Please give me some of your stop insight. So essentially, here, let me finish the question. I also wanted to ask you if there was a setting on Trade Manager that you could use to set a dollar amount that if you hit will automatically shut you out for the day. And that's an excellent suggestion, but no, there is no such feature on Trade Manager. At least not that I'm aware of just yet. But if that's something you'd like to see, by all means shoot an email to Adam at indicatorwarehouse.com and he can make that sort of thing happen on a future upgrade. All right, let me make my typeface a little bit bigger here so that you can see what's going on. Okay, so this is a problem that plagues a lot of you, right? It's if I'm taking these little $50 or $100 profits, what happens when the market really backs up on me on one of my trades and stops me out? Okay, so first and foremost, we have to remember that we need to control our risk, right? We always want to control our risk. Well, ideally anything less than 5%. 5% is prudent, 2% is the ideal of your trading capital. So if you're trading, say, a $10,000 account, that 2% of that is going to be a $200 trade. That's going to be your maximum risk exposure per trade. All right, so however you set up your trade, you're going to try to limit your risk so that every time you're trading around that $200 area. And that's, of course, where the Trade Manager comes in so useful. And I've already forgotten to turn my Trade Manager on. Bear with me here a moment while I do that. This is what the Trade Manager is going to do for us, right? It's going to limit our risk exposure so that we never have more than $200 in play if we're trading a $10,000 account. With the Trailblazer, because the Trailblazer does not have that risk component, we're going to have to adopt a stop strategy, maybe a fixed tick stop, or one of the ATR variants, that we're going to have a decent idea of what our risk exposure is going to be. And it looks like the market's in a little bit of a tailspin right now. Okay, so here's the problem with trading. Every trade you take is essentially a 50-50 trade. On the surface, there's a 50% chance that you will win and a 50% chance that you will lose. Yes, some trades are higher probabilities. You know, we look at those first micro macro cross trades, we look at the macro pullbacks, we look at the you know, in the eagle, maybe a red bar buy or a green bar sell. Each of our tools has a high probability signal, but at the end of the day, really it boils down to a 50-50 trade. So the problem originates from the fact that we're looking at two sides. Oh, what happened to my typeface here? We're looking at two sides of the same coin. On one side of the coin, we have the scalp side. On the other side of the coin, we're going to call it the trend side. The scalp side, we're looking at short, small profits. And on the trend side, we're going to look for larger profits. Okay, so these are the two ways really that you can trade. You can either scalp in and out quickly, get smaller profits for your trades, or you can try to capture those bigger moves and go for larger profits. Here's the problem. Your percentages get very lopsided. On your scalping, you have a high probability of success. On the trades where you try to trend and get larger profits, you have a lower probability of success. All right, so these two things are actually working against each other. This is why it's so problematic for traders. You know, what do? Do I go for the short-term profits, or do I go for the larger profits? Well, it's a little bit of a balancing act, and it all goes back to the whole situation where you essentially have a 50-50 chance of being right or wrong on the trade. So let's take a look at the scalping scenario first. So we're looking for short-term profits, and we're going to say that we're going to risk twice as much as we have for a profit target. I know I don't usually talk about risk-reward ratios, but this is one where we're going to incorporate it. So we're going to risk twice as much as we're looking for a reward. So what's our risk? Well, our risk is 2%. And let's say we're trading a $10,000 account, so we're going to have $200 per trade. All right. And I already said that the trades are going to be, we'll start with a 50-50 scenario. So if we have 5 winners, we have made $500, right? Out of 10 trades. We're gonna do a 10 trade example here. So we have 5 winners, we've made $500 because, well, we're going to risk 2%, and our reward is going to be half. So, sorry, our profit is going to be half. All right, just so we're clear here. So reward is half, risk is 200, 50-50 trade. We've got 5 winners, that's $100, or $500, $100 per winner. 5 losers, we're going to have, sorry, all thumbs here this morning. We're going to have $1,000 in losses, right? 5 losers at $200, $1,000. 5 winners at $100, $500. So in this kind of situation, 50-50 signal isn't going to work very well for us. We're not going to be around very long trading like this. So now we got to play with the numbers a little bit. All right, what if we have 6 winners? That's going to be a $600 profit. And out of our 10 trades, we're going to have 4 losers. So now all of a sudden we've got $800 in losses. better, but still not desirable. We're still losing money, right? It's only a matter of time before we go bust. So what if happens if we have 7 winners? We'll have $700 in profit, and we'll have $600 in losers. Aha! We have found the tipping point. Do you see that? If we have a system where we can get 7 winners and 3 losers out of every 10 trades, we will make money. Yes, we're only making $100, right? Profit or loss. We're only making $100 here, but at least we're making a profit. So even in the grand scheme of things, if you wanted to make more money, all you had to do is not trade more often. You can see trading more often, not necessarily a good way to go, because it may introduce more losing trades, but rather go from 1 contract to 2 contracts to 3 contracts to 10 contracts to 20 contracts. That's how you're going to increase your profitability. Not by trading more often, but rather by making sure that those 7 winners you take, you don't take more than 3 losers, because that's going to be your tipping point. All right, so in actual fact, if we did this out of 100 trades, you would find that you need to be right 67 times out of 100 to break even. So 67% is your break even. That's how often you need to be right to have, just to get by on break even. You can't lose more than 33% of the time. This is why, or this is how you trade if you're trading a tight profit target. All right, so you're going to be right more often, because that's how you improve your profitability, is by having a closer profit target, right? We see this on the Hawk all the time. We take our first micro macro cross signals, and you can do this on your own. I'm not going to take all the time and go through this, but you go through your chart, you find your first micro macro cross. Okay, well, there's one that obviously worked out real well. Here's one. It looks like this one hit its profit objective also. No, that's not one. Here's one. All right, so you can go through, you can find 10 first micro macro cross signals, and 8 or 9 out of those 10 are going to work out. That's why the first micro macro cross signal is so powerful. That's why you can make money trading just that first micro macro cross signal, because you have this situation now where you've got at least 7 winners and no more than 3 losers. All right, so I hope that makes sense. Now let's go to the other scenario where we're going to look for longer term profits. And in this situation, we're going to, because we're looking for bigger profits, we're going to flip this. We're going to go with the traditional get twice the reward for your risk. So we're still risking $200, because that's 2% of our trading capital, but now we're going to look for a $400 winner. All right, so how will that work out? So if we have 5 winners and 5 losers, we're going to have $2,000 on the win, because we have 5 winners. And if we have 5 losers, we're going to have $1,000 on the loser side. So you can see this actually works out pretty well if we can produce a 50-50 system. Now let's see if we can't find where the break even is at. So let's say we only have 4 winners here. That's going to be $1,600 on the win side. And if we're going to have 6 losers, So that's going to be $1,200 on the lose side. So we're not at break even yet. Let's go with the 3. Oh, sorry, yeah, that's 4. So 3 is 1,200, and 7 is going to be 1,400. So what you're actually finding is that we're back at the inverse of the 67%. We're actually going to be at a 33% break even. So if we go back here to 4 winners and 6 losers, we'll have our, this is as close to break even. Somewhere in between here, we're going to hit our break even scenario. So when you're going for a larger profit objective, you need fewer winners and you can tolerate more losers, providing you don't risk more than you can afford. The problem is the profit objective. It's not going to be as easy getting those profit targets, those $400 profit targets. They will come, but you're going to lose more than you're going to win. Your probabilities are going to be skewed the other way. So whereas we were looking at those short-term profit targets, we were getting high probability signals because we're only looking for the market to move 5 or 10 or maybe 20 ticks. With the bigger profit, we're going to lose more often, but when we hit, we're going to earn more money. So these scenarios are actually pretty accurate. You're going to lose 6 trades out of 10. But so long as you win 4 times out of the 10, you're still going to make money. So what you need to do now is you need to look at your trades, and okay, this is the eagle. And we're going to be looking at, for risking $200, we want to make $400. So here's roughly our scenario. And you can see that this nice little rule of 3. Oop, I need to do this like this. Sorry. I need to go to manual mode. So we're going to risk $200 and I need to make 400. So there's about, not enough. So there's about, roughly. So here's roughly our $200 trade, and we have hit our $400 target. So today that worked out very well for us. Let's go back here. Let's take this signal. So let's say we took it here and we're risking $200 away. Okay, that signal also worked out well for us. So right now, the market is being very responsive to this type of scenario. Let's go back to yesterday. No, yesterday we actually put in a decent rally later in the day. Let's go back to the day before. Here we go. So now we're risking our $200 and we don't make our profit target. So you're going to find that when the market is trending, it's going to be very easy to make that kind of trade. But when you go through here, you're going to find situations where, oh, okay, well, that one made a liar out of me. It eventually hit your profit target. But you get my point. You're going to find these situations where you're not going to hit your profit objective because you're looking for a bigger profit. I hope I'm not getting too ham-fisted here. It's not that difficult to understand when you think about it a little bit. But what you need to do, I suppose, is you need to figure out what side of the trading coin you are more comfortable with. Are you more comfortable with going with the 7 small winners and the 3 small losers? Or are you more comfortable going with the 4 bigger winners and the 6 bigger losers, right? Because it's all relative. So long as you're turning a profit at the end, it doesn't matter what the amount of this profit is. So long as that it is profitable. After that, you just add more contracts. Now, the other thing to remember is that when you're in a trade, let's say you had a great big profit objective, and let's go back here where things are a little choppier. And let's say we took this trade right here, this red bar buy, we set up our $200 stop, and we're looking to make $400, and now the market is peeling against us. There's almost always a situation where you're going to have a chance to roll your stop, right? So even from here, once the market starts moving in our direction, we have an opportunity to roll our stops. And I've admitted this to you guys before, but if I have a weakness in trading, it's that I tend to tweak myself out of a perfectly good trade. I tend to get too quick with my stops out of the gate. And I'm like everybody else, right? I don't want to incur a loss on a trade. But I know that if I just left the trade alone, it would do what it needs to do. It would get it out of its system and hopefully go on to hit my profit objective. But the point I'm trying to make here is that even if you started with $200 risk down here, I know it says 300, we're pretending. With a $200 risk down here, there's going to be an opportunity somewhere through the trade to roll your stop up. So even if things go very poorly for you, you haven't lost more than you can afford, and hopefully you get an opportunity to at least roll your stop up to reduce the risk if, in fact, the market moves higher and at this point turns on itself and takes you out. I sure hope that made some sense. It's, like I said, it's two sides of the same coin. You just need to decide for yourself what side of the coin you want to be on. And it doesn't mean that you have to trade that way every single time. Like, we've got different tools here, right? That's why you trade one way with the scalper. That's why you trade another way with the eagle. And the falcon and the raptor are kind of in between there. And I hope I just didn't confuse the heck out of everybody. Okay, good question from Mo. Mo says, well, Eric, what if the 3 small losers are big losers and shoots the 7 small winners? That's why you need to control your risk. Never let your losers get out of control. This is the only part of the trading equation that you have any control over, right? You have zero control over the reward side. You can hope, you can set up your trade and try to get that, but so long as you're maintaining your risk, you'll be okay. Because then when you have the 7 losers, I know what my 7 losers are worth, right? 7 losers at $200, that's $1,400. Did I do that right? Yeah, that's my risk. 7 losers, $1,400. So I know always what my risk side of the trade is. Oh, yeah, I did that right. Yeah, Mo says the stop is the dilemma, where to place it. And that's very true. It's always tough to figure where to place your stop. If the market structure is good, and by that I mean, okay, let's go back here to, well, it's not the North American Open, but here we are. We're going to focus on this first micro macro cross signal right here. Can you see why this first micro macro cross signal is a high probability first micro macro cross signal? Well, we've had the market move up. We've had the market move against us. We've had the bulls try to recover the trend. And then we have the sellers taking out the low. And we're producing a first micro macro cross signal. So there's a very good chance the market's going to try to get down here a little bit and search for some new low. How do I know that? Well, we've made a lower high, right? The market is only in an uptrend so long as it makes higher highs. Once it stops making a higher high, then there's a chance that the market's going to head lower. So at this point right here, the bias is starting to shift. It's starting to shift from bullish to bearish. So when I print a first micro macro cross signal, it's worth giving it a go. Now, where do I place my stops on this one? Here, we'll roll it over like it's real time. Well, it makes the most sense. It doesn't make sense to put the stop right here. Even though we hit our profit objective, there is always the possibility that the market may try to retest one more time, right? Because it's still just the early breakout. We got the breakout right there. Still just an early breakout. So I would put my stop, well, you can always use the macro line because we may anticipate a macro pullback. But given this little swing right there, this is where I know the sellers got active, right? If I'm going to sell, I want to be in line with the sellers. Where do I know that the sellers got really serious about selling? Well, right there. So that's where I'm going to place my stop. Or fundamentally, that's the best place to put your stop. Yeah, exactly. Tony says the test of the extreme made this a high probability signal. Now let's compare that with what's going on right now. Okay, let's go right here. Another first micro macro cross. Is this one as juicy as the one that we saw earlier? I would say not so much. Why? Well, we're in a strong downtrend. No question there. All of a sudden, the market starts to make a serious sideways drift. And yes, this may just turn out to be nothing more than a bear style flag. But, and it's still worth taking. Don't get me wrong, it's still worth taking. But the market is starting to drift. Whenever I see the market start to drift, I start thinking it's getting tired, right? There could be a short-term trading range. There could be a bunch of things going on here. Are we trading near yesterday's lows? I think we are. This whole 4190 area seems to be pretty familiar from yesterday. Oh no, sorry, yesterday's lows were around 4130, I think. But at any rate, is this signal still worth taking? Yes, absolutely. It is a first micro macro cross signal. Where would I cover it? Well, again, I wouldn't cover it too tight. I wouldn't cover it. I might cover it here by the macro line, but I have these swing highs very close by, right? So we've got, this is where the sellers allowed the buyers to get. That's the highest point they allowed the buyers to get to. So that would be a good spot to say, okay, I'm wrong about the trade. And here we drifted down, we hit our high probability target, and then the market starts to try to go against us. But look, even if we had done nothing with our stops and left it up there, we would have rode out this enormous swing, and we're still in the trade. And the whole time, I'm not risking more than I could afford to lose. This is very hard to do, by the way. Don't think for a moment that I'm saying this from my ivory tower saying, oh yeah, this is how you need to do it. I recognize how difficult it is to take this first micro macro cross signal and to leave your stop up here and don't touch it. Especially if we're going to try to go for a larger profit objective. If we're trading on the Falcon, I know we're not, but pretend we're trading on the Falcon and we're going to try to go for our higher probability, so we're risking 200 and looking to make 100. I know how hard it is to sit on that stop and watch the market move against you, move against you, move against you, and hope and pray it doesn't tick high enough to hit your stop. And then finally it hits my profit target. You see, there's many of you will have heard of Paul Rotter. He's the human high frequency trader. I suppose that's, what do they call him? The Euro flipper or something like that. Paul Rotter trades anywhere for 3 to 5 ticks, but he will trade 1,500 shares a day, or maybe it's 150,000 shares a day. He trades insane volume. So does he have, a better signal than the first micro macro cross signal? No, probably not. Whatever signal he's looking at, or whatever he does to generate a signal, obviously he needs to generate probably about 100 trades a day. And out of those 100 trades, as we saw, at least 70 will be profitable and 30 will be losers. But because he still shows a profit at the end of it, even though it may only be $100 a share or whatever it is, because he's trading such enormous volume, it still works out to be, like a several $100,000 a day. Yes, I did say a day. But he skews the probabilities in his favor by taking these insanely tight trades. Like I said, for him, a long-term trade will be 5 ticks. He'll look to scalp 3 ticks and be done with it. Now, for you and I, it is a possibility, but you really got to have a good conversation with your broker, and you got to get some very good commissions. You can bet that Paul Rotter pays a fraction of the commissions that we do. Because, if you're trading for 3 ticks and you're giving away a tick or two to the brokerage and the exchange, that's not going to help you very much. That brings in an interesting point. If you're going to trade that way for the smaller profit target, very often you will do better on a higher tick instrument like the E-mini. I suppose that's one reason the E-mini is so popular with scalpers, because you need that extra couple of dollars that the E-mini is going to offer that you don't necessarily get on an instrument like the NASDAQ. I wouldn't recommend going as high as the bonds at $31 a tick. You're not going to be able to hang in there very long with a smaller account. But if you're trading the E-mini or the Russell or crude oil, even for that matter, gold, any of those instruments that are trading at around $10 a tick, 10 or $12.50 a tick, you'll do all right. Yeah, Mo says using the macro line for a stop is probably a pretty good suggestion. And again, a lot of times when you take a signal, if the market is going to retreat, here's a first micro macro cross. If the market's going to retreat, my first thought is that it's going to become a macro pullback. And the macro line is essentially a moving average line. So this is where it crests here. This is the maximum of the average of the prices, right? So it gives you an idea anyways of where the average of the price may have topped out. But again, Mo, the most important thing here is to maintain your risk. Don't ever let this amount become more than you can afford. That's when you start to get into trouble. Okay, so that was my little soapbox lecture. And you can play with it yourself too. Just take some numbers and crunch them and just see. Oh, this is how many trades I need to be profitable. This is how many trades I can allow to go against me. And that also it drives home the point. This is the last point I'm going to make about it. Is that the less you trade, the more you skew the probabilities in your favor as well. Right? Those days where you trade 8 or 10 or a dozen times, you're going to incur more losers. You just can't help it. So do you trade big enough that when you win, the winners are offsetting the losers? That's the big question. If not, then you need to reduce the frequency of your trades, or you need to change your profit objective and change the way that you're thinking about the market. Floyd asks, what stop loss do you need to scalp 5 ticks? 2% of my trading capital, Floyd. And I'll try to place my stop below a structural point on the chart, a pivot of some sort. If I can afford that, I take the trade. I don't. Okay, I know what you're asking me, Floyd, and I'm not trying to be a wise guy about it, but if you're looking to make 1 point, you can risk 2 points, right? If you're looking to make $100, using the E-mini as an example, that would be 1 point, 4 ticks. So you could risk 8 ticks. Right? So that's the other way you could do it. Is if you're looking to go here to the fixed high-low, and we're going to go off of the low, and I'm looking to make 20 ticks, and I'm going to do this on a scalp, so I'm going to risk 40, and let's say it's not going to work now because it'll be approximately like this. All right, so there my scalp trade. Oh, what am I doing wrong here? There we go. Okay, it's going to look something like this. And with the fixed tick, I can't enable it now because it's not going to show it correctly. And by the way, if you're using the fixed tick scenario and you want to go 40 ticks off the low and it's displaying on the wrong side, put a little minus sign in front here. And then click accept. And it's going to flip it down the other way. But you can see it's 40 ticks off of these lows, not 40 ticks off of this low. I needed to do this a little earlier. But if I wanted to do this type of scenario, if I wanted to risk $200 to make $100, that's where my stop would be. and the fixed tick strategy will give you that. So now here I am, I'm nursing this trade. We're back down here at the lows. The market will hopefully start to rally. And as it gets up here, I may choose to take my $200 stop and I may choose to roll it down here. So maybe now I only have $150 at risk. So if this trade folds over on itself, I might be watching here. Oh, is this going to work into a first micro macro cross signal? Okay, if it goes into a macro pullback signal, then, you know, I'll definitely take my stop from down here. So let's say we're still watching to see whether the buyers can get together. Okay, so now we're into yellow bars. Things are going in our favor. Jim says the advanced decline pretty even up right now, 1229 to 1554. Okay, so now we're getting a green bar sell. The sellers are coming back a little bit. Now might be time to roll in my stop. And like I said, this is something, you're not alone. This is something I struggle with as well. Trying not to be too quick with my stop. So obviously we see that the sellers are here. Okay, the buyers are coming back. And we'll see whether they can take out the high, this little itty bitty swing high. That would tell us that the buyers are in total control. Come on, get up there. I know it's incredibly hard to do, but you will always do better as a trader if you treat it as a little bit of a trading game, and that the money is only a means of keeping score. I know it's hard, but it's true. Phil Ivey, a world-class poker player, said, and this is a guy who's playing, you know, for $200,000 a hand. He says, as soon as I think of it as money, I'm sunk. Because if we didn't think of this as money, as real money, our real hard-earned money, would we really, where would we place our stop? That's the big question. If this wasn't real money, if this was only a game like Monopoly, where would you put your stop? Would you put your stop right here? No, probably not. Would you put your stop at break even and hope and pray that the market goes higher? No, probably not. You'd probably put your stop right there. And you'd probably leave it alone. Or you might put your stop right here, or maybe below the little micro swing right there. But you would give this trade every opportunity to work out. If the market started to move against you and you thought, oh, I'm going to roll my stop back, give it another chance, then this is where your stop needs to be. See, so here we are. We're about 7 ticks to our 10 tick target, or pardon me, 18 ticks to our 20 tick target. The auto break even program, if I'm running it, would have the stop at break even by now, but let's just hold it here. Let's hold it and see how this plays out. Oh, that was the other thing I was going to mention to you that I forgot. Is how does break even start to skew these numbers? Well, the break even really starts to skew things in your favor. So let's say, for instance, you know, that we're going to risk twice as much as we're looking for profit. We're going to be scalpers. So our reward is $100. Our risk is $200. And we figured that we needed 7 winners and we could afford 3 losers. And we would be ahead $100. Now, don't let these zeros fool you. The point that you're profitable, that makes all the difference in the world. Okay, so what if we employ a break even now? And let's say that one of the break evens negates one of the losers. Well, now we only have 2 losers, right? So our losses are only $400. And our profit goes up dramatically just by eliminating one of the losing trades. Now, you can say, well, what, Eric, your break-even target can also eliminate one of your winners. Yes, that's true. So what if we had 6 winners? Well, that's $600. We're still in a good scenario here, right? And it improves your overall profitability, which is the most important part. So break-evens will help your trade scenario considerably. If you can get your break-even to the point where, what if you eliminated another loser because of your break-even? Now you would have $100 loss. And again, I can hear you saying, okay, well, Eric, what if you ditch another winner because of a break-even? Okay, we're still skewing the numbers in our favor. That's why you see me use break-even triggers, because as I've mentioned before, if the market gets 3/4 of the way to my profit objective, I'm thinking, time to take profit. And if the market backs up on me, takes me out of break-even, okay, well, so be it. I'll probably get another opportunity to get in. We're just looking at the hawk right now, but and we took this red bar buy signal here, but look at in the exact same neighborhood, we're getting a green bar sell that we could buy a breakout above the high. So there's never a shortage of opportunities to get in. And sometimes if the market is just on a tear, like we saw yesterday where it just goes higher and higher and higher and higher, you don't ever see me do this in the room, but there are times where if the market's on a tear and it's on a tear, just hit the buy button. Just go in with something small. Just buy a onesie because the market is going. Right? The market is, in this case, when the market was unwinding here, it's going lower and you're hoping, well, am I going to get a macro pullback? Am I going to get a 4-arrow consolidation? Come on, give me something. And it doesn't. Just hit the sell button. Just hit the sell button. Go in with a onesie. Place your stop. And, if the market is on a tear, you'll at least pick up something. All right, so here we are. We're still nursing our trade. Had we run our break-even trigger, we would be flat and we'd be looking for another opportunity. Yes, thanks, Tony. Tony says crude report out in 15 minutes. Actually, Tony, I think it's out at the top of the hour. Natural gas, I think, is out at 10:30, and crude is out at 11 today. I'll double check that. All right, so it looks like right now the market's really drifting sideways. No real follow through at the moment, at least not for the sellers. It looks like their selling attempts have been squashed. We'll just keep playing with this for a little while. I don't see anything going on in crude oil. Yeah, Jim confirmed that. Thanks, Jim. Natural gas at 10:30, crude out at 11 today. that's of course because of the holiday this week on Monday. All right, so now we're getting a first micro-macro cross lower. We're still kind of nursing this this trade. We could take our stop here from the $200 mark, roll it up to here, so we have about $150 more or less at risk. And you can also see the problem if we were taking this trade and we were looking for our $400 profit target, right? We're going to flip the coin and we're going to get twice as much out of profit as we are on the risk side. We got a lot of time to sit on our hands if we're going to hit our profit target up here. If we're going to 42.10, we got a lot of waiting to do. That's going to affect your frequency also of your trades. Like I said, it's the same coin, just two different sides. So gold on a little bit of a tear this morning. I'm just leaving this up because I'm curious to see how it's going to play out, but let's take a look at the gold market. I'm going to start paying more attention to gold because we're getting some very nice moves out of the gold market. Gold opened back here. That's the North American Open. The stock indices opened here, and as the NASDAQ and the stock indices were tanking, look at that nice smooth rally that gold put in. That's beautiful. And that, of course, is on the Eagle. You'll have comparable signals on the Hawk and the Falcon also. And it looks like after that little early morning breakout, that's all they got for us right now. They're really trading punches where we're at. Don't know yet if the sellers can resume this downtrend. Obviously, we've got a bit of a trading range going on, right? For those of you interested, you've asked me this before, you know, should I buy the bottom end, sell the top end? This is the time to do it. Here, we'll demo this. So here's our limit order. We'll buy as prices get down here. Let's say we'll buy 41.80. We'll risk it down there. Oh, that's 5 contracts. I'm not going to do that. We'll go in with a onesie. So we'll buy 41.80. We'll risk it down to here. I can afford a little bit more than that. There we go. All right, so let's see whether or not we get another bounce. The sellers are pressing a little bit. You see how we're making lower highs. I heard a trader once say regarding trend, and I thought this was so true. If you don't know if you're in an uptrend or a downtrend, you're in a trading range. So if you look at your chart and you don't know, you can be pretty sure you're in a trading range. So we're going to try to get cute here, and we're not going to get our $400 target, but we'll see whether or not they get to the top end of the trading range, and we can look at taking profit then. And you can see so far not too bad. There's certain advantages to trying to trade this way. The most notable being that you can get in with minimal risk exposure. I'm doing I should actually tighten this. So $300, we're going to risk half. There we go. Close enough. when you're in a trading range, the pivot point always seems to be in the middle of the range. So as we get higher here, the bears are going to get more aggressive and they're going to start selling, selling, selling. As we get lower here, the buyers are going to become more aggressive and they'll start buying, buying, buying. I guess that looks to be about the middle right there. Yeah, I agree, Jim. Jim says it looks like they're waiting for something. I don't know what, but they were waiting all day yesterday for that FOMC minutes, and nothing came of it. David, no, the crude inventory report is not at 10:30 today. It's at 11. When there's a holiday Monday in the week, they moved the crude inventory to Thursday, and the report is released at 11. Natural gas is released at 10:30. So here we are in our little trading range, and so far we're doing pretty good. And, you know, I don't focus on these types of signals very often, but it is certainly doable. If you've recognized that the market is in a trading range, then by all means, feel free to buy the lows and try to sell the highs. So here we are. We rode out yet another swing on our hawk trade, and we're still hovering here just below our profit objective. If we were using the fixed tick stop, it would now also have us rolled right here, and it would hold us. Even though the fixed tick, if this were live, it would not be retreating. It would just print the line right there. Come on, get up there. Yeah, I agree, Jim. Jim says looks like it might be time to go long. Yeah, Tony says they're looking for me to place a trade so that they can move the other way. Yes, I know. It sure seems that way sometimes. Hooray! So after all that, we hit our profit objective. But you know what? This was a very interesting exercise. How by, just leaving the stop alone, the trade finally worked out. And so long as we're turning a profit at the end of the day, really, that's the whole point of the exercise, isn't it? All right, let's put that there. And here we are with our Eagle trade. Let's see now if they can actually get into that top end. See how the sellers are starting to beat them up? We're about, what, maybe 2/3 in toward the top? And look at where the sellers start jumping on them, or us. Oh, thanks, Ryman. Ryman says gold. Seems like he's been watching the news here. He says gold stays lower after upbeat U.S. jobless claims data. U.S. jobless claims fall by 7,000 to 262,000 last week. Yeah, it could be. You know, the thing with the with the news is it always gets changed to fit what's going on in the market. We're always trading as well. We're always trading against the big boys. We're trading against banks and stuff here. We're not trading against each other. I don't know if you've ever considered that. You know, like when we take a trade, I'm not trading. It's very unlikely I'm trading against, you know, Joe Blow in Atlanta or, you know, some fellow in Germany or something like that. I'm probably trading against Citibank or you know, somebody. I'm trading against a big institution. They're betting I'm wrong. I'm betting I'm right. And now we have different motivations as well, right? I may be satisfied with a $150 profit, which I totally am. They have different trading programs and everything going on to suit their objectives, whatever those may be. But the fact remains you cannot make money unless you are going in the same direction that the market is going. A simple point, but one that very few traders are able to get a handle on. All right, see, I'm going to do my best here to be patient with this trade and not get myself out of this. We'll see how this one plays out. It's painful to watch though, isn't it? When you have money on the line and you just want to get that stop up to break even. But I'm going to hold it here. And just trying to give them some time. I forget who it was. I think it was one of the members in the trading room here who said that he takes a trade in the NASDAQ and he just leaves a stop above the high or the low, whatever the case may be, whether he's buying or selling. And he leaves it alone and he just lets the trade go for the day. And more often than not, it ends in a profitable position. So, for instance, what if we did that yesterday? Okay, so the market opens, makes a little bit of a run up, makes a little bit of a run down. If we place the stop down here and bought, say, right here, how would that have worked out if we had left that alone all day? That probably would have worked out pretty good, don't you think? And the market closed right about here, actually, where we took this trade here. Would have been an insanely profitable move. So where are we today? Well, today we're kind of doing the opposite, aren't we? The market opens here, falls off. We had a nice rule of three right out of the open. What if we placed our stop up here above the high, had sold here, and just left the market alone? Where would we be at the end of the day? You know, certainly at this point, I would at least bring the stop to break even. Interesting exercise, though. Nice thing about trading is you can do all that sort of stuff, right? It's fairly easy to back test these kinds of theories, even manually. Just go back into your chart and say, all right, I let the opening range expire, and let's see, can I even cover a trade like that? We're going to do the opposite here on the Raptor. We're going to sell the bottom end of the range. So we're going to sell down here. We're going to cover way up here. Obviously, we're just kind of horsing around here a little bit because there's nothing going on right now. That's a bit of a spread there. Let's see, 41.78, 42.13. Yeah, that's a $700 spread. That's going to be a little bit rich, but like I say, we're playing today. Well, we're still back here at the bottom end of the trading range. I'm just going to reduce that. I almost thought we were going to see them break out, but no, not yet. Yeah, I know Jim says it's kind of brutal holding on to to a trade this long, and it is. It does try your patience. So had I had the trade here at break even, of course, we would have been stopped at break even. And there's nothing wrong really with doing the break even scenario because it's, as you saw, it improves your overall profitability, or it can. Okay, so we got filled now on the Raptor. Oh, I should adjust these things here too. We're going to try to be a little bit more aggressive on our profit. So you can see the stop ultra big here, but let's just play with this. We've got the big range here this morning. We're have an obvious channel. It'll be a very interesting exercise. I can honestly say I've never done this way. Yeah, good point here from Tony. This is something, that a lot of people don't consider. Tony mentions that that last range box really shows that while the market looks like it had some direction on a shorter time frame, it is in a sideways market. And that's an important point to remember. The market will always be trending on one time frame, and it will always be ranging on another. It's kind of an interesting little paradox that, if you go to a short enough time frame, whether it be, like a 30-second chart or a 100-tick chart or a one-tick mean Renko chart, there's always going to be a trend somewhere. And if you go to a high enough time frame, whether it be an hourly chart or a daily chart or a monthly chart or whatever, there's always going to be a trading range as well. Well done, Jim. Jim says, okay, that short was at 10:07. Now it's 10:40, but he made 14 ticks on 4 contracts. Good job. I know. It's a tough day today. Just kind of watching and waiting. So here we've got the 2 opposing trades. We had the breakout. Now we'll see whether the buyers try to recover, get it back into that trading range. And here we had the breakout that we sold, and we'll see whether the sellers don't take the market back again. Well, there's not a whole heck of a lot going on today, folks. I think we may button things up here a little bit early. I'm going to continue to play with this through the rest of the session. If you are going to trade, I think the bears have got a handle on the day today. I think we're going to see the market continue lower, maybe even get down to 41.50. But, for the most part, they're still really inside this trading range. And remember, when we get outside of a trading range, that's when we can look for better selling opportunities, right? We get that breakout, we get that retest. If this does not drift too high into the market here, and then we can anticipate the market to come out and offer us a signal. If you are kind of following in on this trading range trade, this might be a good time to start getting more serious about adjusting your stops as the market goes a little bit higher. And on that note, we'll button things up today. See you back here on Friday. I do anticipate after a little bit of a sideways day like this that Friday may be a little bit more active, which would be a nice way to go into the weekend. All right, you guys and girls, we'll see you tomorrow. Bye for now.